Yeah, no, there's a lot there, but I'll do my best to unfold it. The first thing is that there's no doubt, like when I first started learning about Bitcoin, it was digital gold, right? And this was back in 2012, 2013 when I finally took my plunge. And the digital gold narrative is very old. Like that's pretty much the first thing we all learn about. But what happened was through that process, I learned about digital gold. And just like when gold miners learned about their gold, what did they want to do? They wanted to make their way out west and they wanted to start mining it. Well, I learned about that digital gold and I wanted to start building these rigs and start mining it. And that's where my journey began. But shortly after that, maybe like 3-4 years after I started mining, we had the actual creation of what I call the internet economy, which is more widely referred to as decentralized finance right now. And in the decentralized finance world or in the internet economy, it's the only economy in the world that offers free market interest rates on its money. Every other economy in the world has a central bank that states the federal funds rate and states an anchor rate, and then those anchor rates affect the whole yield curve. It's not a free market price discovery process where the interest rate is based on the supply of money and the demand on loans and the perceived counterparty risk. It's actually just a price control stated rate. But in the internet economy, we do have a free market interest rate, which means that Bitcoin being that digital gold of the internet economy, it evolved into, because of these decentralized finance solutions, the reserve asset of the internet economy. And then what we find out is that Bitcoin takes the best of gold and US treasuries. See, it backed the entire system up until 71. And some of the problems they had with gold, of course, were security and settlement, because you would have to secure the gold and then you'd have to settle the gold across the world. And sometimes it could cost more to secure and settle the gold than it would in the interest you paid to borrow against it. So there was a big problem there. And then enter scene of US treasuries. US treasuries enter the scene and they say, well, this is just a Web 2 interface. You can just type the numbers in on the computer and settle immediately. Like there's no problem with settlement, and there's no problem with security because it's a closed, centralized system that's secured with certain protocols with easy, cheap, and quick settlement. But it created a new problem, and that is the problem that we see today, which is inflation, which is there is no limit to the amount of expansion of US treasuries. Therefore, you have severe dilution in the asset class. And now here enter Bitcoin. You get the best of both worlds. You get the hardness of gold, which means that it's not going to see dilution. But you also get the quick, easy, secure transaction finality and settlement of treasuries with Bitcoin. So it's the natural evolution of the next best collateral. So as the reserve asset of the internet economy, once it displayed those characteristics, the best of gold and the best of treasuries, it, to me, became known as the most pristine form of collateral in the world. And as the most pristine form of collateral in the world, now we can start to integrate it into these old debt products, which are just based on US treasuries. And that creates a hybrid product that gives you the benefits of everything that we're looking for, kind of like the best of both worlds, so to say. And because Bitcoin is that engineered money, because it is digital gold, the reserve asset in the internet economy, and most pristine form of collateral in the world, how and why did it get there? Because it was engineered that way, because it was strategically designed to drive value into the network by leveraging the natural laws of economics and price discovery to empower the holders by driving value into the network. Bitcoin is the only commodity in the world that can raise or lower its own cost of production. There is no other asset or commodity in the world or good or service that has the ability to with a custom difficulty adjustment. In Bitcoin, we call it the difficulty adjustment, but there is no other mechanism in all of the world that allows a commodity to adjust the cost of production of itself. And Bitcoin does that. And as more and more miners try to earn the subsidy, that pushes up the hash rate. Hash rate means block times go less than 10 minutes, which means difficulty goes up. So increased hash rate means increased difficulty. Increased difficulty means increased cost of production, which means the producers of that Bitcoin, just like any other good or service in the world, they have to charge a price. They have to ask a price above the cost in order to stay in business. You cannot sustainably offer your goods or services to the marketplace at a price below the cost. You'll go out of business because there's no profit. and profit is the invisible hand that drives marketplace incentives. So with that being said, we can go to the second part of your question, which is yield and price performance and what that kind of means, because people think of cash flow as the main source of income, but in this case we have price appreciation as the main source of income. So for those of us who sold some Bitcoin and bought some treasuries at 5% because it's the best deal we've had in a long time, yeah, you got 5% cash flow on your principal, but you missed out on over 100%. Actually, excuse me, you missed out on over 500% of price performance. So it's the 500% increase in purchasing power from holding your Bitcoin that is blowing the performance out of the water compared to the 5% that you're getting for holding a US Treasury. So we need to, you're right, get beyond thinking about just cash flows and think about how Bitcoin's compounding annual growth rate delivers price performance versus just establishing cash flows. But at People's Reserve, we want you to get the best of both worlds. We want you to get the cash flow, but we also want you to maintain exposure to Bitcoin upside. And that's what the Bitcoin bond does. The Bitcoin bond is a hybrid product that combines the debt of the issuer of the bond. Our first issuance will be done by PR Financial, who will issue a US Treasury Bitcoin hybrid product. In the future, we are going to be working with counterparties who issue their own debt at the sovereign and corporate level. So that'll be interesting as well. But if you want the United States printer as your counterparty, then you would buy this original issuance, and 80%, roughly 80% would go into US Treasuries at a Treasury note, a 5-year note at 4.5% roughly. And what that does is that creates the cash flow for you. So every quarter, you're going to be able to get your cash flow distribution in order to pay your expenses. But at the same time, the other portion of that note, the 20% allocation, is directly structured into the note as a Bitcoin position. So as the price of Bitcoin continues to go up, you have exposure to that price performance. And the actual debt portion of the structured note provides principal protection. So if you invest $1 million into a Bitcoin bond, $800,000 goes into the treasury. $200,000 goes into the Bitcoin. Over the course of 5 years, $800,000 at 4.5%, it matures at a value of $1 million. So it's the guarantee of the United States printer who is going to absolutely print the money and pay it to you. What you'll be able to buy with that money at that time, I don't know. That defines the problem we all face today. But you're going to get that money back. What's left over is the Bitcoin performance. So even if Bitcoin price stays the same, and after 5 years, that $200,000 of Bitcoin that was originally allocated is still only worth $200,000, well, then the Bitcoin bond matures at a value of $1.2 million. And that $200,000 is 20% of the million principal invested over the course of 5 years, which is a 4% APY. So if you invest in a Bitcoin bond and it's a 5-year bond or a 5-year note and Bitcoin price stays the same over 5 years, you're getting 4%, which pretty much matches the rate in the marketplace today. But as rates continue to go lower, with the Fed stating rates lower, the Bitcoin bond is going to far outperform. And if Bitcoin does what you and I think it's going to do, which is compound at a 60% annual compounding growth rate, or you even cut that rate in half to 30%, well, at a 30% CAGR, you're talking about 20% APY. At a 60% CAGR, which is what it has right now over the past 10 years, you're talking about that 200,000 going 10x and turning into 2 million. So you have the 2 million Bitcoin position plus the 1 million of principal protection. The note would expire being worth $3 million, or up 200% over 5 years. So in simple interest terms, 40% APY. So the Bitcoin bond gives you the best of both worlds. It creates the cash flow that you need to get off the hamster wheel and enjoy your life and increase your quality of life and standard of living. But it also maintains exposure to the best performing asset in the world, Bitcoin. And then you benefit from that price appreciation, which again is not based on speculation, but actually based on the engineered functions of Bitcoin, the strategically designed characteristics of Bitcoin that drive value into the network. Now we have a guaranteed value driver as our yield producer rather than just a printing machine.